Hey traders, it's John Fortune here with this week's weekly Forex forecast. I hope you're having a great weekend. We are in today's video going to revisit the US stock market. Why? Because it has reached a decision point. It's decision time for the US stock market, and I'm going to show you in today's video exactly how close current market conditions are to that of 2008 and the great financial crisis and the crash which followed. Okay, so quick look first at the economic calendar, because last week was dominated by this CPI print on Wednesday out of the US, and because it came in lower than forecast and also lower than previous, the market took this as a view that 75 basis points in the September FOMC meeting is now likely off the table, and they essentially priced in 50 basis points, and we saw the knee-jerk reaction initially in the dollar selling off, and that caused actually other markets to move, and even the New Zealand dollar with some unexpected strength from this piece of data, which we're going to look at in today's video. And we also had last week consumer sentiment coming out, which was better than forecast, better than previous, but 55.1 is actually back at 2008 levels and is not overall a very strong reading for consumer sentiment. So better than forecast, better than previously, but actually historically very, very low still. And a couple of key things to note coming up for this week is we do have some inflation data out of Canada, but the first real important piece of data is the New Zealand interest rate decision on Wednesday. You're likely going to see the markets correcting, not doing much in terms of the New Zealand pairs into Wednesday. And as you saw last week, and I constantly say, if you hold positions through these interest rates or through these major news events, you are taking more risk because the market gets more volatile. So by definition, more volatility equals more risk if you're holding positions through them. So you can either trade around them, or if you want to be safer, you want to take less risk, wait until these interest rate decisions or the news events pass, and then look to trade in that direction if it fits your plan, which you've previously worked out. So we do have an interest rate decision out of New Zealand on Wednesday. I'm going to be looking at the New Zealand pairs next week, but they will be from Wednesday onwards. So I'm going to wait for the interest rate decision to come out. And then if they move in the direction we are planning today, I will look to trade them. And we also have CPI out of the UK. Now, this is likely also to cause volatility. And don't be surprised if the pound pairs kind of do nothing into Wednesday. If they kind of correct and don't move into Wednesday, that is your sign that the markets are likely to get very volatile on Wednesday itself. So again, you've got three options. You can trade around it, you can actually trade after it, or if you want to hold through it, just be aware you are taking more risk. Okay, so let's look at the scorecards heading into next week. And the first thing of note is that the US dollar and the euro are both negative. So when you have both the US dollar and the euro on the positive side, or both of them on the negative side, as I've said many times previously, this shows that market opportunities are less abundant, and it just means you should take down your risk somewhat. Doesn't mean you don't have to trade. I am still going to be looking at trading, and we're going to go through the best opportunities that I see next week in this video, but it does mean that market conditions could be better, and there will be a time in the near future when there are many more market opportunities available. So that's the first thing to note, maybe take down a little bit of risk going into next week. The second thing to note, which is interesting, was the net change of 2 in the New Zealand dollar, taking it from -1 to 1. Now, why was this interesting? Well, because this was a very rare occasion in the scorecards, because the previous week, so not last week, but the previous week before that, the New Zealand dollar was already at +1. And then to get to last week's score of -1, we had a net change of -2. And then we had exactly the same change the following week in the opposite direction. So we had really a whipsaw here in what we were looking at in the scorecards. And that is very, very rare, because the scorecards themselves are built, they're designed not to get you whipsawed, because there's no use having something go up and you say it's strong and you buy it, and then it whipsaws down, and then you sell it and it goes the other way. So they're designed to avoid whipsaws. This is why we don't really see them very often. And in fact, the only thing that can really cause this in the scorecards is a significant economic event like the CPI data we had last week. Why the New Zealand dollar was especially responsive to that, to the upside, I don't know. If anybody has any ideas on that, let me know in the comments what your thoughts are, because I still don't know why the New Zealand outperformed so much compared to the other currencies when the US dollar sold off last week. But either way, the fact is it did, and going into this week, this does mean I am interested in New Zealand long plays, which we're going to be looking at, but with the interest rate decision on Wednesday, they're going to be from after Wednesday. So if we get the New Zealand dollar rallying on Wednesday, I'm going to be looking for follow-through trades to the upside Wednesday, Thursday, Friday. And the final third and very important piece to take away from the scorecards is the pound going from -1 to -2. When we have a currency scoring on a 1 month forward looking basis weak and it's getting weaker, or if we have a currency which is strong and getting stronger on a 1 month forward probability basis, those are the best signals. So pound shorts absolutely are going to be a primary thing I'm going to be focused on this week. And I'm primarily going to be looking at pound yen to the downside. We're going to be looking at pound franc to the downside. We're also going to be looking at pound New Zealand and pound Aussie to the downside. And then after the pound, I am interested in euro shorts as the second worst scoring currency. And again, we're going to be looking at euro yen to the downside, euro franc to the downside, euro New Zealand to the downside, and euro Aussie to the downside. Okay, starting with the individual currencies, just to get an idea of what's going on the daily chart, and we're starting with the DXY. The DXY sold off over here on the 10th, as you can see when we had that CPI reading, and it really just corrected pretty much 2/3 of the move, maybe you could say 50% of the move after that. So the dollar index has been in a correction since the July 14th peak, and nothing has really changed as of last week. That did not break the correction, it did not reverse the DXY to the downside, and in all probability, whenever this correction resolves itself, a new high up above the previous high, possibly into the 109.76, is still the most likely probability. However, as you can see in the scorecards, they're telling you the dollar is kind of neutral and it's not yet time to jump in and be very bullish on the dollar. But as you can see quite clearly here, not only are we still above the 102.992, which was the 7-year breakout, the dollar uptrend bull market is still intact. Next is the euro, and again we're on the daily chart here, and have a look at the euro. Now, doesn't this tell you a bit more of a story than what we just looked at in the DXY? Because don't forget, these two markets are likely going to move in the opposite direction, almost certainly. And you can see here we have two levels on here. I tweeted about this previously with the euro, and the breakout level of the 1.06710 is the 4-year breakout level, and the 1.03750 is the 7-year breakout level. All we have done so far in the euro, which again mirrors the inverse of the DXY, is to pull back and retest the 7-year breakout. The first sign that we may be getting a bigger reversal in the euro would be if we broke with momentum above the 1.3 or 03750, sorry, which we haven't got just yet. But even then, we may only be coming back to retest the 4-year range breakout. You would have to have a real clear momentum break above the 1.06710 for this to start to be considered a possible inverse head and shoulders and a major reversal. This, as it currently stands, is a very bearish chart, and I am looking for further declines in the euro vis-a-vis the other currencies that we're going to be looking at next week. Next is the pound. We did previously have, and I mentioned in last week's video, the Bank of England projecting the UK economy going into recession at the end of this year, the 4th quarter, and being in a recession all of next year, 5 consecutive quarters. That is not good for the currency. They have to ease the currency, weaken the currency in order to stimulate growth. And so fundamentally, the pound does have a very bearish bias overall. And in terms of what we've seen recently, again, this is just, as it currently stands, a correction. I am looking for further declines. And pound shorts, as I said, along with euro shorts, are my two favorite plays to the short side heading into next week. Next is the Swiss franc. Now, we've been bullish on the Swiss franc. It's been on the best long side for a few weeks now, and it has paid quite nicely. The only Swiss franc pair which didn't work last week was the New Zealand Swiss franc, because we had that massive rally in the New Zealand dollar from the CPI data. We did take out both targets to the upside in the Swiss franc. Any correction in this market is simply viewed as an opportunity once again to look for bullish setups. But just bear in mind, in the scorecards, it is actually weakening. And for that reason, I've left the Swiss franc pairs on here because they are bullish, but they kind of go to the bottom of the list this week because that is really what the data is telling me to do. But Swiss franc long plays in the form of Eurofrank to the downside, pound franc to the downside are still going to be opportunities I'm going to be paying attention to, but I prefer these other currencies vis-a-vis the yen, the New Zealand and the Aussie next week. Next is the Japanese yen. Now, the Japanese yen is currently bullish, but as you can see, and I mentioned this in previous videos, one of the problems is that this is just a counter trend move, and we're probably coming back maybe even to retest the major breakout of the 0.0079. So yes, I am bullish on the yen, and the scorecards are telling us to look still for yen strength. I'm going to be looking at pound yen, euro yen to the downside next week, but I kind of would prefer to be long on the dollar if the dollar can start to break higher and break out of the correction, because the dollar is in an overall bull market. So I prefer dollar longs, but right now, going into next week, I do still favor Japanese yen long plays. Next is the CAD. We actually broke out of an inverse head and shoulders here in the Canadian dollar, but it's not particularly strong. It's kind of neutral. And so overall, we are kind of in a range, but because we broke out of this, and because the scorecards themselves are telling me that they're kind of neutral on the CAD, I really don't like CAD pairs going into next week. It's a week, as I said, to take down a bit of risk. And so I really want to be focused on what looks like the best opportunities. And I don't think that's the CAD pairs next week. Next is the Aussie. The Aussie has been kind of bullish to neutral in the scorecards for a while. And we did last week break out of an inverse head and shoulders. And this looks to be even the right shoulder of an even bigger inverse head and shoulders, and it does look like we're going to come back and test the neckline here at the 0.72805. So I do like Aussie long plays heading into next week, and as you can see, EurAusd to the downside and Pound Aussie to the downside are two markets I'm really going to be paying attention to next week. And last but not least, the New Zealand dollar. We had a huge spike off of the US CPI print. The only thing I can think of is that this outperformed to the upside because traders last week put money into the New Zealand over and above other currencies last week because they wanted to invest prior to the interest rate hike this week. Apart from positioning around and prior to the interest rate decision this week out of New Zealand, I can't really think of any other reason why this would outperform so much to the upside. You might say, well, it's one of the more volatile currencies, but then the Aussie usually outperforms the New Zealand in that scenario, which it didn't last week. So that suggests it's something very specific to the New Zealand which caused this rally last week, and not just the fact it's a volatile commodity currency. But either way, this is where we currently sit next week. We traded into the previous high over here, and this is actually a key area of resistance. And as always, this happens very often with markets. They get into a position where they can go either way ahead of major interest rate decisions. So we could see a break higher like this on the interest rate decision, and we get this kind of double bottom. Or the New Zealand is in place to actually reject from the resistance area and come down like this. And this is why next week it's going to be preferable to wait for the interest rate decision to take place first and then look to take trades based off of that. Because of what we're looking at in the scorecards, my primary bias is to the long side. That's Euro New Zealand to the short side, and Pound New Zealand to the short side. So what I would like to see heading into next week, I would like to see from Wednesday the market correcting, perhaps like this, and then breaking higher on Wednesday. And any pullback like this would be your opportunity to look for follow-through trades in the New Zealand pairs. So again, highlighted in blue because we have a news event next week, don't forget. Okay, so let's have a look at the markets next week, starting with euro dollar. I do euro dollar every week, but I'm not really looking at trading euro dollar next week. Why? Because I have a strict process, which I adhere to, and the euro and the dollar are both weak. They are both bearish in the scorecards on a 1 month forward looking basis. When that changes, I will get back involved in euro dollar. But you can see here, really just mimicking what we saw in the euro index, we have pulled back and retested as a bear flag the major 7-year breakout level of the 1.03434. Just looking at the technicals here, I would say this is probably now the top. Maybe we come up and retest it once more, but this looks to be more or less the top in euro dollar. And we've also pulled back and retested this previous low, which is the black line. That was the low we broke with momentum, and then we pulled back correctively and tested. So I do think, just as higher highs is the higher probability in the DXY towards 109, I do think lower lows is the higher probability in euro dollar. But I would rather just get a little bit of a momentum breakout first. No need to try and top tick this. I'd rather be a bit patient on euro dollar before I look for those shorts. Okay, so dropping down onto the 4-hour chart here to look at the rest of the markets, I am interested in crude oil shorts to the downside. And last week we were very close to target, and I said I wanted to see this market really correct to get more risk to reward on the trades into the 87.73. So any pullback is still simply viewed as an opportunity to look for bearish reversals, bearish breakouts. And we're going to be looking down towards the 87.73, and if we can break through here, down towards the 84.49. So the first Forex pair here is Pound Yen. Now I've highlighted in blue the Pound pairs and the New Zealand pairs. The New Zealand pairs I am not going to be trading at all until Wednesday onwards. The market in the New Zealand dollar is most likely going to do nothing between Monday and Wednesday. So the probabilities are if you get involved even in short-term trades, you're probably going to get chopped about Monday to Wednesday. But the pound pairs, because it's an inflation print, slightly different. We can see those markets moving Monday, Tuesday, Wednesday. So it's important to separate these two because I am going to be looking at potential short-term trades in the pound pairs before Wednesday, but not in the New Zealand pairs which have an interest rate decision. So going into next week, I actually wouldn't be surprised to see pound yen selling off pretty much from the get-go. Why? Because we already have a bearish reversal here. See how we broke down and we started to pull back and retest this? I would not be surprised to see this coming down, taking out the lows, maybe even into Wednesday. And then maybe on Wednesday we get a reversal, some profit taking. So I am going to be looking at shorts in pound yen. First of all, as I said, down to the previous lows and then onto the 158.07. Again, don't be surprised to see this go pretty much off the bat from Monday to Wednesday. Next is Euro Yen, also another market I wouldn't be surprised to see go pretty much straight away next week. We have a very mini in the 1 hours. I think this is a double top over here, and this is actually the overall head of a downward sloping head and shoulders, which is when you get downward sloping head and shoulders, you are more likely going to get a strong momentum move to the downside. And if you have upward sloping inverse head and shoulders, you are more likely to get a strong momentum move to the upside, as opposed to, say, downward sloping head and shoulders like this, or inverse head and shoulders if you're looking to the upside, and in this case, as opposed to if you have upward sloping head and shoulders like this. So I am looking further declines, and again, don't be surprised to see this pretty much go from Monday, maybe even into Wednesday. But pound yen and euro yen are two of my top plays heading into next week based on what we're looking at in the scorecards. If you are shorting pound yen before Wednesday and you hold through Wednesday, don't be surprised if it whipsaws or profit taking comes in. And again, you are taking a risk if you hold through the news. Next is pound Aussie. This market is very strong to the downside. We have huge momentum. Don't be surprised to see this market correct first, perhaps into Wednesday, because you have a strong move. You often need a little bit of a stronger correction. But any pullback in this market, and a pullback really would be fantastic, and I would prefer to see a pullback first, perhaps into Wednesday. Any pullback is going to be viewed as an opportunity to look for shorts in this market down to the 1.6918. Next is pound New Zealand. Now, because it's a New Zealand pair as well as a pound pair, I would definitely be waiting until Wednesday or after Wednesday to trade this, because you have two big pieces of data coming out on Wednesday, and this pair could get quite volatile. But you can see we broke, and what was I just saying in the previous charts we were looking at? Downward sloping head and shoulders, and what did we get? We got a strong momentum move, a bigger sell-off than if you would have just an upward sloping head and shoulders. So what we're seeing here, think back to maybe pound yen, which you could be seeing next week or in the coming weeks. But any pullback in this market, it'd be great if this pulled back into Wednesday like this, and then on Wednesday, we got a breakdown like this. We got momentum in the direction of the trend. That would be fantastic. I'll be looking at shorts into the 1.8732. Next is Euro Aussie. Now, I really like Euro Aussie next week because we don't have a news event in this market at all. We don't have pound. We don't have a New Zealand in this. So any pullback, and we've broken out of this correction here. We're now starting to trend to the downside. Any pullback will be an opportunity next week, in my opinion, a great opportunity to start to look for shorts. And I'm going to be looking down towards the 1.4329. And when we break through here, there is nothing but air down to the 1.3987. It's probably not going to do that in a single week because it's a huge distance, but we could cover this ground quite quickly, perhaps over a couple of weeks. If you want to take a more conservative target, take the psychological level of the 1.42, which is more or less between those, as a kind of medium-term target. But I really like Euro Aussie next week. Euro New Zealand, the best thing that could happen with Euro New Zealand is that this corrects into the interest rate decision on Wednesday. If this starts to correct into the interest rate decision, I'm looking for the break on Wednesday into Thursday, and any pullback is then the opportunity to start to look for shorts all the way down to the next key area of support at the 1.5594. Next is Eurofrank. This was a market I said to look for shorts last week, and this was a great performing market. This was a really, really good market. We had a big sell-off last week. We just missed the target at 0.9577. Now, this chart is a little bit of a worrying chart for the euro. If I zoom out here into the weekly chart, look at where we are in Eurofrank. We are right at the bottom of the 2015 franc shock. If we break this level, and the target we are just about to take out, which was last week's target, is the low of the 2015 Swiss franc shock. If we take out this level, I have no idea what is going to happen to Eurofrank to the downside. We could very well break with momentum, and this could actually turn into a bit of a problem for the euro. When you combine this with what we've been looking at really all year with the dollar index, and I've put the dollar breakout thread into the weekly Forex forecast videos on Twitter that you can follow or have a look at. You can see that in the comments or in the description. But when you compare this, this is really pointing to a serious issue for the euro. And when you get a currency at all-time lows, or if you get any market really at all-time lows, or you get a market at all-time highs, a market at all-time lows is not a buying opportunity. It's a selling, it's a short. And if you get a market all-time highs, it's not a selling opportunity, it's a buying opportunity. So this is something which could spell a little bit of a problem. And especially if you compare, this is now two currency markets with the euro where we could be at the point of major breakdowns, because euro dollar, we've broken the 7-year range, pulled back and retested, and in euro Swiss franc, we're about to break the major low of the 2015 Swiss franc shock. I'm absolutely bearish on euro Swiss franc, and I wouldn't touch this to the long side with a barge pole. And the final forex pair is pound franc. This was a market we were looking to the short side last week, and this was another good short. We took out the target and we've broken through this. I've been saying in recent videos that once we took out this target and we broke this low, there is nothing but air between the 1.1119, and we could come down here pretty quickly, and we saw some momentum coming into this. So any pullback in this market is viewed as an opportunity to look for shorts. If you want to take the psychological target of the 1.1300 as a kind of medium-term target, you can. But the next key of support to the downside is the 1.1119. And when you compare this to what we just looked at in Eurofrank, we could be seeing quite a strong appreciation of the Swiss franc in the near term. And in fact, it may cause the SNB to step in and intervene. So just be prepared about that. But what I'm seeing here in pound franc and euro franc is potentially a little bit worrying. Okay, so wrapping up the video with gold, silver, Bitcoin, and then we are going to finish with the US stock market and why I think it's decision time and how closely the US stock market resembles the 2008 financial crisis. So having a quick look, starting with gold, I'm on the weekly chart here. Don't usually look at these markets on the weekly chart, but because the DXY is kind of neutral, I am not really interested in gold, silver, and Bitcoin next week. I would like to see the DXY either being very bearish or pretty bullish, and then that will give me a better bias on gold, silver, and Bitcoin. So I'm personally sitting out these markets. I do think they could come a little bit higher because the DXY correction is not yet over. Maybe it comes down a little bit lower first. But the point of looking at this on the weekly chart is just to show you, I view this as a counter trend move currently. And the reason I don't want to be long, even if this goes a bit higher, is because A, it looks like the dollar could turn pretty much any day or any week. And if it does that, that's going to put downward pressure on gold, silver, and Bitcoin. And at the same time, we're just retesting the previous low here. And although we're breaking through it, I just think upside is fairly limited. So if you want to be trading gold, silver, and Bitcoin, yes, near term, we could come up a little bit higher. I suppose I am slightly bullish on these markets all the time the DXY correction is continuing. But because I think the upside is capped, I would like to see these markets reverse first, and then the better money-making opportunity, in my opinion, is for the next decline into the 1676.87. If we look at silver, also on the weekly chart, you can see that we broke out of the major breakout level back here in at 21.42. And we may just be coming back to retest this. So again, there may be a little bit more upside here the whole time the DXY is correcting. But this is not a bullish chart. I would not like to risk this reversing and selling off just to capture a little bit up in this area. I'd much rather trade something like pound yen or pound franc, which is really selling off hard to the downside. So yes, this could come up a bit higher. Perhaps we retest the 21.42, but you have the risk of a reversal if the DXY starts to break out of its recent correction. Again, you can see really we're just testing previous lows. And finally, Bitcoin is also coming up to test the previous low, as I discussed in the previous weekly Forex forecast videos. If you remember, at the start of the month, what I said to you guys was, I think we are going to see the VIX coming down to 1850, and that is going to provide a little bit of risk on for 1 week or so. And you can see it's already taken a couple of weeks. We've been seeing a bit of risk on. But once we start to take out these lows and we're sitting there in gold and silver, and I think we come up and test the low in Bitcoin, I do think we are then at risk of seeing these reverse to the downside. And that is when I'm going to start to be looking short. And what those 2 weeks of risk on, or 1 week of risk on, now been 2 weeks, is likely to do is paint the upper wick of the monthly candle. And that is what I think we're seeing here so far. We've got this, and I think the risk is for the rest of the month to come down like this. Okay, so I want to leave you with this because this is very important, but I'll keep it quick because of time. All the way back in May, I posted a thread on Twitter about market sentiment to say that the market sentiment in this current bear market is actually very similar to 2008, because a lot of people at the time were saying that it's a contrarian signal, sentiment's very bearish, so therefore we should buy the market. But that actually is a misunderstanding of market sentiment. Market sentiment is contrarian, but not at extremes. If you have extremely negative sentiment, that actually is usually confirmation of a major top. It's not contrarian at the absolute extremes. So the market sentiment since the beginning of this bear market has been mirroring that of 2008 compared to other drawdowns in the markets. Now, if we look at how this has actually unfolded, this is also extremely uncanny the way the market itself has played out in comparison to 2008. You can see here in the SPX, we have one move down, 2, 3, 4, and then we have a fifth, and now we have come back to test the high of the previous fourth wave over in this area. If you look back to 2008, that decline is almost a mirror image of what we saw in 2008 down into the late summer lows. Then we had the rally taking out the top of the fourth wave in 2008, and that is exactly where we currently sit in the SPX. And in 2008, that was the point at which the market started to roll over, and from peak to trough in 2008 was about a 20% decline. The peak to trough of this market's decline is about 24%. We then took out the high of the fourth wave, and then we had a capitulation in the stock market, which took the overall market down to a decline of -54 from the peak. So it's very interesting to note that sentiment matches 2008 and has done all the way since the beginning of the bear market, and price itself matches the initial stage 1 decline of the S&P 500 in 2008 as well. And in previous videos, I highlighted the 1845 or the 1850 of the VIX. I said, I think we're going to come down into the 1845. We'll probably see a week or so of risk on as this happens, and then we could run into some serious trouble. Why? Because at the same time now that the SPX is taking out the wave 4 high, which is exactly what happened in 2008, where was the VIX in 2008 if we scroll out? The 2008 market crash took place from, you could say, between 18 and 19 in the VIX. That was where we got the major rally after a pullback into this level. And it just seems very uncanny that all of these things are lining up. So is the market in the US at risk of capitulation? And of course, if the market were to capitulate in the US, that would be a global market capitulation. Other markets would go as well. Well, the problem is a lot of people are pointing to the US economy and saying, no, the Fed really isn't breaking anything because consumer sentiment's improving. The labor market is quite strong, and all of this is actually fairly true. Although the labor market is one of the last things to go, the US economy isn't actually doing that bad. So I just wonder, maybe we are overlooking something, and maybe there is a serious risk here of capitulation in the market, but maybe the issue is not going to come from Fed tightening. Maybe this time it comes from elsewhere, and that could be China. So keep an eye on this as the market trades into the 1845. I'm not saying there is 100% going to be a crash. I'm just painting the picture that I see based on everything that is taking place now and compared to 2008. And the reason I say this is decision time is because not only is the VIX at the level which caused capitulation in 2008, but the market itself is at the exact same resistance area, you could say, at the wave 4 high, which saw the 2008 market capitulate as well. So that is why I say this is, in my opinion, decision time. If we break the 1845 to the downside, we're probably heading down to 1189, and that would see all-time highs in the S&P 500, and you would see the market breaking cleanly through. Maybe it comes back and retests the wave 4 high and continues. But if the market starts to bounce at 1845, and I'm talking about the VIX here, and at the same time the S&P 500 rolls over from that wave 4 high and starts to sell off, we could have a problem in global stock markets. So that is it from me for this week, guys. As always, I hope you enjoyed this video, and if you did, please let me know by liking, sharing, and subscribing. A big thank you to everybody who does that on a regular basis. And I want to wish you all a fantastic weekend, and I want to wish you all the best in your trading next week. The only thing left to say is take care, and don't forget to trade safely.